Hey team, Coach Thorman here, and today we're talking about the HSA, also known as the Health Savings Account, and it is awesome. We got a great show for you. Now, what's mind-blowing, 87% of people that own an HSA are not maximizing their accounts. The HSA is arguably way better than a traditional 401k or IRA, and way better than a Roth 401k or Roth IRA. But most people are screwing this up, and they're throwing away possibly millions of dollars in their lifetime. And we're going to show you what is going on so that you don't squander a couple of $1 million. But wait, that's not all. There is a hidden tax trap within the HSA that I've only seen one other person talking about, right? Hardly anybody's talking about it. And this is a hidden wealth destroyer for your family, and we've got to address it and prevent this from happening to you. And we're going to do that. So watch all the way through this video so you don't miss this special tip.
So huddle up, team. We are John and Tara Thorman, your financial success coaches, and we help entrepreneurs, influencers, business leaders, and self-employed professionals win their money games and build generational wealth. This is a great show today, guys.
Okay, so here's some facts on the health savings account that you need to know. And what is really mind-boggling is that so few people really know what is going on with this account. And it's amazing. Okay, first, the HSA has got triple tax benefits. Okay, let me break it down for you. Number one, you get a tax deduction on all of the money that you put into this account. It goes in pre-tax, just like your 401k plan. So it reduces your adjusted gross income, so you pay tax on less money. That's awesome, right? So now this changes every year, but in 2024, if you're single and under 55 years of age, you can contribute $4,150, okay? A married couple can contribute $8,300. Now, there's an interesting little catch-up provision. So if you're 55, you get to put in an extra $1,000. So if the couple are both 55, they each get to put in an extra $1,000, right? Next, the earnings inside of your HSA grow tax-free. So that means you get to compound your money faster for the future. So that's totally awesome. And you're familiar with that. I mean, that's how 401ks and IRAs work, that the money goes in and it grows tax-free, tax-deferred. But here's the difference. With your HSA, the distributions, the money coming out of your HSA to pay for your medical expenses, to pay for your qualifying medical expenses, is tax-free also. There is nothing like that. You don't get a tax deduction and have it come out tax-free anywhere. This is the only place that you get this triple tax benefit is in the HSA. Now, it's important to note that with the HSA, if you pull money out for anything other than a qualifying medical expense and you are under age 65, yeah, you'll pay taxes on it, but you'll also get hit with a 20% penalty. But at least you can get the money, right? But if you are 65 or older, you can pull money out for any purpose whatsoever, okay? Can I hear Cabo San Lucas or something, right? And you don't get hit with a penalty, okay? You'll just pay the taxes on it after age 65. So that's just like a regular 401k or IRA. Any money you pull out, you pay tax on. But this HSA is so powerful. Tax deduction going in, grows tax-free, comes out tax-free for your medical expenses.
So why don't people know this, and why are they taking advantage of an HSA?
So good question, and I think there's several layers that go into this, but so few people are actually taking advantage of these accounts. Look at this graph. It's showing that less than 10% of the workforce are taking advantage of health savings accounts, right? And I mean, it's regional. You can look at this, and we are living in Florida. That's our residence. And it shows 7.2% of the workforce, people aged 18 to 65, have a health savings account.
Wow.
And so you can look at your state and you can see, if you're in Texas, what is that, 9.7%? What's mind-blowing, this is the worst thing, okay? and this is something you got to pay attention to because you can fix this. You can prevent this from happening to you. 13% of HSA account holders are actually investing their HSA money. All the rest, that 87%, are earning next to nothing. It's sitting in their HSA accounts, earning 0.7% or less. Sometimes it's zip. That's awful. And so we're going to show you what's going on here so that you can fix it. In reality, okay, your investment options with your HSA are virtually unlimited. This account registration is so flexible. It's incredible what you can do with it. The limits on what you do with your money inside the HSA are really imposed upon you by the custodian that you choose. And the beauty is you can change it whenever the heck you want to. Want to invest in your favorite ETF? No problem. Just go to a different custodian, switch it up. Want to invest in real estate or gold or crypto? No problem. You just got to change it up. What we want to use in that example is a self-directed HSA. So you can invest your HSA money in things that you know and love and have the opportunity to earn the highest rates of return. If you're doing some hard money lending and making 15 or 16% a year, you could use that. Okay, put your HSA money into that kind of an option using a self-directed account. Now let's take a look at what this means over a lifetime, because you can only contribute in your HSA until you're 65. But then you can keep that money and have it continue to grow and compound until you need it, maybe until after you're 80. So we got a long time here to compound some money, and the difference is millions of dollars. So we're going to compare and contrast a health savings account where they're just saving the money versus a health investing account where they're investing the money. For a single person, they can right now contribute $4,150 a year, and this will go up every year, but I'm just going to keep it locked in at this for making it simple, right? $4,150 a year. If you do what 87% of people are doing, it's just sitting in an account earning next to nothing. So at 0.7%, after 30 years, you have $144,000, 138. See that? No more contributions now at age 65, but that money can continue to grow. And so 15 years later at age 80, if you've not pulled out any money yet, you got 160,000. Okay? For a single person that is serious about this and moves their money and invests it and earns just an 8% average rate of return, that same $4,150 a year, after 30 years is worth $583,405. If you stop contributing and just let that ride and don't touch it for 15 years later at age 80, you've got almost $2 million. Look at that, $1,929,274. That difference is monumental. That's enormous. Look at this for a married couple. $8,300 a year at 0.7% grows to $288,276. Stop it and let it ride till you're 80, it's $320,000. But if you put the money to work, if you actually invest it at 8%,
such a difference.
It's crazy, right? $1.1 million by age 80, $3,858,552. This is like generational wealth impact kind of money, right? Now, why is this important? Well, it's important for a few reasons. Number one is we are living way longer, right? And a 65-year-old couple right now today, the odds are that one of them are going to live into their 90s. Not just 80, but into their 90s. So we got to take this into effect. And healthcare costs are rising faster than the rate of inflation. So it's insane. So if you're 65 now, it's estimated that a couple age 65 today will spend $315,000 in out-of-pocket medical expenses during retirement. Okay?
I got 2 years to go.
2 years to go. But if you're younger and you're getting started, 35 or 40 years from now, that 315 with inflation, you could be looking at $1.2 million. So this is like real money that we've got to plan for. So here's how you can invest your HSA money so you aren't stuck with 0.7% interest rate. Okay, change custodians, move the money. And what I love about this is you don't have to settle. So if you're doing this through your employer, they take your contributions in every pay period, they move that money into the custodian and it's invested where it's invested. Well, you can move it. You can transfer it out of that custodian and put it somewhere else. You don't have to leave it there. I mean, they can keep doing the deductions and contributing the money for you every pay period, but then you can just swipe it out of there and roll it over into a different account. If you're self-employed or you have your own business, of course, you can set up your own account. If your employer doesn't offer it, you can set up your own account. You just have to have a high deductible health insurance policy. Now, here's a kind of fun cash flow management concept here too that you can take advantage of. Pay for your medical expenses using a credit card with a big cash back offer. Pick up 2 or 3% or more in cash back, and then take your HSA account and pay off your credit card. Just a little side tip for those of you that love cash back rewards, right?
Your reward money.
Yeah. Now, here's the number one mistake people are making with their HSA. And guys, it is a ticking tax time bomb, okay? This is important. And nobody's talking about this. Well, virtually no one. The HSA, are you listening? The HSA is the worst account for you to leave to your beneficiaries once you die. The only exception is if you're married. You can leave your HSA to your spouse, and they get to continue it, without any interruption, okay? But here's the deal. If you leave your HSA to a non-spouse beneficiary, the HSA is terminated, and that money, that balance, goes to your beneficiary, and for them, it's treated as ordinary income in the year that you died, and they're going to pay taxes on that full amount.
Correct.
And that could bump them into a higher tax bracket that they're paying taxes on. This is not a good thing. This is a very inefficient distribution or wealth transfer of your money, or if you're the potential beneficiary and you're expecting this inheritance from your parents or your grandparents,
Tell them no.
change this quickly, okay? We got to make some adjustments here because you do not want to inherit an HSA because you're going to have a massive tax bill. Like massive tax bill, depending on, your tax bracket and your state taxes and all that kind of stuff. This could be awful. You may want to just give your beneficiary some other money, like a Roth 401k or a Roth IRA, because that's going to be tax-free to them. And use the health savings account as a contribution to your favorite charity, because they don't have to pay taxes. But you get, the benefit of giving your money in a more tax efficient manner. I think that's really the big thing here is if you own the HSA, you don't want to give up, 25% or 35 or 50% of it to the government, right? You don't want that happening. So you've got to be aware and do some different tax and estate planning so that this goes the most tax efficient way to the people that you want it to go to. So here's the primary requirement to open an HSA, which is, to your point earlier, why aren't more people doing it? Well, one, you have to know that it's available. But two, you have to have a qualifying health insurance policy, and it's a high deductible health insurance plan, okay? In 2024, the requirements there that you have an annual deductible not less than $1,600 for an individual or $3,200 for family coverage. Okay. So you can go to your HR department and figure that out. If you're self-employed or running your own business, that's awesome because then you can deduct your health insurance premiums, but make sure you got a HDHP. Make sure you got a plan that qualifies for the HSA. But guys, plan well. This HSA, you can use this to your advantage to accumulate tax-free wealth like nothing else, and set it up right so that your beneficiaries don't get dinged when they inherit this money down the road. If you found value in this video, oh my gosh, please crush that like button right now, subscribe to this channel, and leave us a comment. We'd love to hear your thoughts on this and maybe another topic suggestion that we could cover in a future video. But have an awesome week, and we will see you on the next video.